Good evening, everybody. Ladies and gentlemen, it's indeed a pleasure to be here amidst such a distinguished gathering. The theme of the summit, the rise of Indian spring, is both contextual and inspiring, reflecting not just the rising trajectory and profile of the Indian economy, but also the sentiments prevailing within the country and across the globe. As a regulator, it is our endeavor to promote a robust and resilient financial intermediation system with appropriate regulatory and supervisory frameworks in place. During my address today, I therefore intend to share some perspectives on how we are building and enabling regulatory framework to prepare the Indian financial system and entities to support the nation's growth aspirations while ensuring that there are adequate guardrails for ensuring financial stability. Anticipated technological developments and innovations, which we are witness to, hold great promise for the financial sector. They have immense potential to increase the reach of financial firms, enhance the range of product offerings and conveniences to the customers. They have the potential to expand the ambit of finance to hitherto excluded segments of the society, with the added benefits of delivering these products and services at lower costs. But the flip side is we have to be also alert to the possibility that the new entrants into the financial service space, including the fintech firms, could significantly alter the universe of the financial services providers. This could affect the degree of market concentration and competition and may give rise to new challenges. Regulations can be thought of as cornerstones for building trust, enabling integrity, and ensuring stability in the financial sector. Regulations define the boundaries of industry conduct while ensuring a fine balance between fostering innovation and safeguarding public interest. Before I touch upon the specific areas of our potential focus going forward, I would like to outline a few guiding principles that usually help us in deciding our regulatory approach. While each policy formulation focuses on addressing a specific set of requirements, having its own schema and flavor, the policymakers should be guided by three broad guiding principles, namely prudence, proportionality, and proactiveness. Given the dynamics of the Indian financial landscape and the institutional setup, one more principle which is perhaps relevant in the Indian context and to us in Reserve Bank is a harmonized approach to regulations. Let me start with the issue of prudence. Prudence in financial regulations refers to being cautious and sensible in managing the risks within the financial system. It involves ensuring that the financial institutions maintain adequate capital, hold sufficient provisions for loan losses and other losses, and also make sound financial decisions to prevent excessive risk-taking that could lead to instability or systemic failures in the financial system. Time and again, the episodes of crisis have demonstrated that a lack of prudent behavior by one or few entities can impact not just that entity, but can potentially snowball into a systemic crisis. Therefore, when risk management and prudence takes a backseat vis-à-vis the growth ambitions, there is an onus on the regulator to ensure effective functioning of the safety nets in the form of prudential regulations so as to preserve financial stability and protect the depositors' interests. A key aspect of RBI's prudential approach to regulation is having strong processes for supervision and monitoring of banks and other regulated entities. Through this, the Reserve Bank endeavors to have a thorough assessment of the entity's financial health, its risk management practices, as well as compliance with the regulatory requirements. This proactive approach is intended to help the RBI to identify potential vulnerabilities and address them promptly, thereby enhancing the resilience of the financial system. Coming to the issue of proportionality, the principle of proportionality is a concept which we have flagged previously and have implemented in some of our recent regulations. It has to be recognized that over-regulation in any financial sector or any sector could lead to increased compliance costs, affecting efficiency and innovation amongst the market players. Accordingly, the focus is on achieving a delicate equilibrium that addresses the critical concerns without imposing undue burden on the regulated entities. The principle of proportionality is synonymous with a nuanced strategy to ensure that the intensity of regulations correspond to the identified risks. Our policy measures, such as the scale-based regulations for the NBFC, the tiered regulations for the urban cooperative banks, and the tailored regulations for the differentiated banks, such as the small finance banks and the payment banks, are reflective of this approach. Adopting a proactive approach to regulations is also a necessity in the current times. A forward-looking approach in regulation entails identifying and analyzing the emerging trends so as to proactively preempt any buildup of risks. Additionally, this facilitates the recognition of the evolving landscape and provides valuable inputs for regulators to accommodate new developments, systems among the evolving challenges and uncertainties. Being proactive also means remaining attuned to the market innovations and global trends. Reserve Bank has always supported and encouraged responsible innovation. However, there is always the possibility of a trade-off between regulation and innovation. As regulators of an evolving financial landscape, we need to remain alert to the spawning of new ideas and trends in the markets, try and understand their scale and assess their potential to disrupt the markets, and consider interventions where and if necessary. For example, Regulatory Sandbox is one such initiative where the pilot programs can be tested in a controlled environment without any fallouts. This ensures that the regulations evolve concomitantly with new products and services rather than being either preemptive or reactive to the innovations. Finally, of course, the issue of having harmonized set of approach to regulations. Now, the Indian financial system is characterized by different types of financial institutions. Many of these entities are niche players with varying risk profiles. Therefore, they require differentiated regulatory treatment. While recognizing the need to allow for a differentiated regulatory approach, we are increasingly looking to adopt the approach of the same activity, same risk, same regulation. This approach will enhance our oversight capabilities by providing a holistic view of the activity across the financial system. It allows for identification of systemic risks, monitoring of cross-sectoral linkages, and initiation of preemptive measures to address potential vulnerabilities. However, let me reiterate a point I had made earlier, that harmonization does not mean a uniform set of regulations. In fact, harmonization entails a risk-based perspective wherein the regulatory requirements are tailored to specific risks associated with each type of financial entity and activity. The idea is that the regulatory arbitrage should be by design and should not be an option exercised by the regulated entity to take advantage. While we remain guided by these principles in framing the regulations, it needs to be emphasized that in any maturing economy, the regulations must eventually graduate from a rule-based to a principle-based approach. The Reserve Bank too has been endeavoring to adopt principle-based regulations, which means that the regulator will focus on setting broad principles, thereby allowing for a nuanced approach to risk management by the regulated entities. It will help in balancing flexibility with achieving the regulatory objectives. However, an essential prerequisite for the success of such an approach is a financial landscape which values discipline and compliance in both letter and spirit. Else, the flexibility available under a principle-based mechanism might be misused for short-term gains. Therefore, in their own interest, the market players should support such regulatory endeavors through suitably strengthening their compliance culture and governance frameworks. Now let me try to focus on the emerging areas which are engaging our attention at this juncture. These are not just limited to the fintechs and the innovations, but traverse the spectrum of the financial sector. A few areas of focus going forward would include issues of how to go about harnessing the benefit of technology, ensuring good customer service and conduct, enabling a strong governance and compliance framework within the regulated entities, reinforcing and fine-tuning existing prudential regulations, and contain the risks from procyclicality in lending. The key area where a lot of work is underway is evaluating the use of technology in financial services and in assessing how the Reserve Bank as a regulator can harness the benefits of technology for greater public good. The foundation of digital revolution of today has been built on the digitalization push of the Government of India and the futuristic enabling regulations of the Reserve Bank. To give an example, the FSDC, that is the Financial Stability and Development Council, set up a working group in April 2016 to look at the granular aspects of fintech and its implications so as to review the regulatory framework. Sequel that, a discussion paper on peer-to-peer lending was issued in April 2016, and guidelines for the account aggregators, which is a part of the open banking system, was issued in September 2016 by the Reserve Bank. Moreover, the Reserve Bank established its regulatory sandbox in August 2019. All of us here are also well aware for the transformation of the payment space, where we can proudly claim to have the pole position in the globe today. Post-COVID, the digital economy got a push and adaptation rates have increased multifold. This has brought about newer challenges, especially in the digital lending products, such as the issues pertaining to coercive practices, dark patterns, and excessive interest and other financial charges. To address some of these issues, the Reserve Bank issued the digital lending guidelines in 2022 to regulate these practices. Further, when some more innovations in this sector came, such as the first loss default guarantees, the Reserve Bank supported such initiatives by issuing suitable regulations in June 2023. Reserve Bank has thus strived to remain ahead of many of its global peers in nurturing fintech innovations and has issued regulations to support them from time to time. As I have alluded before, with newer players entering the financial services space and disrupting the rules of the game, the banks may become but one among the host of entities competing to win the customer's business. Therefore, the focus of the banks as well as the regulators has to pivot from the intermediation paradigm to the marketplace paradigm. As the consumer preferences change, banking and financial service industry would have to reorient their business models, processes, and products. To cater to this change, the Reserve Bank has started its groundwork on enhanced use of technology in banking, such as the use cases of artificial intelligence, digital ledgers, and so on. Let me also add here that technology brings its own set of challenges in the form of data protection, data privacy, cybersecurity, and technology-induced frauds. These are in fact areas which are increasingly engaging the attention of the regulators, not just in India, but across the globe. You may all have noticed that there has been a renewed focus on strengthening the conduct-related aspects of our regulated entities. Over the past 1 year, we have issued instructions on the responsibilities of regulated entities employing recovery agents, strengthening the conduct regulations relating to pricing of loan-related products, return of loan-related security documents, addressing customer grievances relating to reporting of credit scoring, amongst others. The recent announcement for lenders to provide their borrowers a key fact statement, the KFS, is also an endeavor in this direction. These regulatory initiatives are expected to foster a more responsible lending conduct. These efforts on the regulatory front are being complemented by an intensive supervisory scrutiny of the conduct of the regulated entities, focusing on fair, sound, efficient, and transparent delivery of banking products and services. As we further strengthen our approach towards addressing the concerns in framing and enforcing the conduct-based regulations, the guiding philosophy would be to set out the minimum regulatory expectations with the option for the entities to have higher standards depending upon their size, proportionality, and customer focus. The regulation should ensure that the customers are not misled by false promises and or do not fall prey to unfair practices. Another area of focus is on improving governance in the regulated entities. If one were to choose a single expression that epitomizes banking business, it has to be risk management. This arises from multiple factors, including the bank's fiduciary role in respect of its depositors, their critical interaction with the real economy, and their role in the payment systems and in ensuring financial stability. A strong governance framework and a robust risk management system, coupled with effective oversight by the board and the senior management, provides a greater degree of comfort to the regulator. Recognizing that the governance is a bedrock of a sound banking system, guidelines have been issued to address several operative aspects with regard to the composition of the board, the committees of the board, age, tenure of the directors, and remuneration for the directors. The Reserve Bank has also issued guidelines on supervisory expectations and for providing of sufficient authority and independence to the three critical functions of risk management, compliance, and internal audit. The boards are expected to take an active role in identifying and approving the heads of control and assurance functions and to establish clear lines of communication between them and these assurance functions. Continuous assurance, vetted by an independent process, should give succor to the institution's managements and not just to the regulators. The Reserve Bank will continue to reinforce prudential regulations to ensure that the banks recognize the risks in their balance sheets and proactively manage them. For example, given that our financial system is largely bank-driven, to make it more resilient, we are planning on introducing the expected credit loss framework for loan loss provisioning in the banks. This is a forward-looking measure and a leading identifier of stress. When issued, it is expected to transform the assessment of the credit risk and ensure that the banks will have sufficient buffers through the business cycles to withstand any impact of cyclical downturns. Further, to enable diversification of credit risk and ensure market-based credit products, enabling regulatory frameworks have been issued and put in place. The directions on securitization of standard assets, which were issued in 2021 September, focuses on traditional securitization structures. Further, with a view to developing a robust secondary market in stressed loans, a framework for securitizing stressed assets is also being prepared and is expected to be rolled out shortly. These reforms, combined with the planned rollout of the revised Basel III guidelines, will provide a fillip to the institution's capacity to support the credit needs of a growing economy and aid stability of the financial system. There is also the challenge of procyclical lending and the risks thereon. Unbridled credit growth and any laxity in credit discipline or underwriting standards can be deleterious to the health of the financial entity concerned and, if widespread, could give rise to systemic concerns. From this perspective, post-COVID credit offtake towards the consumer credit segment, especially the unsecured portfolio, was observed to be quite substantial. Also, the increased dependency of the non-bank financial companies on bank borrowings was leading to regulatory concerns. Although the asset quality at a broader portfolio level was not exhibiting any major signs of stress, the consistent high credit growth reported in these segments warranted some kind of regulatory intervention, and accordingly quantitative and qualitative measures were undertaken which were from the macroprudential perspective. As regulators, we would want to ensure continuous vigil to mitigate the risks emerging from both within and from the periphery of the financial ecosystem. Therefore, the digital lending guidelines issued by the Reserve Bank envisage that the regulated entity undertakes due diligence required for lending decisions even when the loan is being serviced through a lending service provider or an LSP. The increased reliance of the banks and non-banking financial companies to identify and onboard customers through fintech partners should not mean lowering of underwriting standards and improper pricing of risks. As a regulator and supervisor, we are examining the prevailing models and practices to see how best they could be leveraged for effective credit delivery without compromising on risk management and prudential credit underwriting standards. I would like to stress here that what has been shared so far is an illustration of some of the key areas of regulatory focus. At the same time, there are several other aspects which continue to be on the regulatory radar. I am sure that through a consultative, collective and collaborative approach, it would be possible to frame an appropriate set of policy measures to address the current and emerging challenges. Through this process, we should be able to build a stable and resilient financial system which shall meet the emerging needs of our country in an effective manner. To conclude, let me emphasize once again that even as the financial landscape evolves and transforms, the underlying principles of good governance, robust risk management, effective compliance, customer protection, and responsible business conduct will continue to be remaining relevant. A robust culture within the organization which delivers financial services while embracing these principles will stand the system as well as the institution concerned in good stead in the long run. Thank you very much. Namaskar.